Very good morning, my dear friends. We are in the chapter Amalgamation. I think so. This is the final lecture for the chapter Amalgamation, where we've seen various issues till now. That is, things related to computation of PC and various methods we work out, and accounting treatment in the books of selling company, 5-step approach we've seen, accounting treatment in the books of purchasing company. If the method of accounting treatment is purchase method, we already completed. Am I right? Now, the one and only issue is pending from my side in this chapter is, if the amalgamation is amalgamation in the nature of merger, then which method of accounting treatment we should need to adopt, that is pooling of interest method, and what are the various journal entries we should need to pass. Such all issues we are going to discuss in this particular lecture. After that, we will resolve certain problems based on pooling of interest method. Then once such one or two problems, I'll make it finish it off. Then we can resolve some other problems which related to the previous examination as well. Okay. Then if at all, if time permits to me, I'll start the chapter internal reconstruction with small intro in this lecture itself. Otherwise, we can able to take up in the other lecture. So that is the agenda for the current lecture. So without wasting much time, please all of you come to my OneNote. And one more thing, guys, I gave one problem as HW, which related to LK Limited. Hope you completed that problem. Still, if you have any doubt in that problem, you can able to ask questions at the end of the session. Okay. Before coming to me, please all of you check the solution material provided to you in the material corner. After that, you can come across your questions with me. So, accounting treatment in the books of purchasing company. If the amalgamation is amalgamation in the nature of merger, right? Amalgamation in the nature of merger. Which method of accounting treatment I should need to adopt? The method of accounting treatment is pooling of interest method. Am I right? Guys, before going to see the accounting treatment, first let me know one thing, all of you. When an amalgamation is said to be amalgamation in the nature of merger, 5 conditions it should need to satisfy. Na? What are those 5 conditions? All the assets and liabilities should be taken over by the purchasing company from the selling company. All the assets and liabilities. And that too, all the assets and liabilities should be taken over at book values only. Next, purchasing company should pay PC only in the form of fully paid up equity shares only. If any fraction of shares are there, then it can issue the cash for the fraction. In the selling company, shareholders holding not less than 90% of the share capital should become the shareholders of the purchasing company after amalgamation. Purchasing company should need to continue the same line of business as conducted by the selling company. If all these 5 conditions satisfied, then generally we can call it as such amalgamation as amalgamation in the nature of merger. Am I right? We already learned such aspects at the beginning of my session, at the beginning of our lectures itself. Now, the thing is, sir, here selling company exists. Let us assume this is selling company balance sheet. Selling company have all their assets. So then under liabilities side, share capital will be there. It inclusive of both equity as well as preference. And the reserves and surplus are there. Various reserves and surplus, it may contain general reserve, P&L account, statutory reserves. Okay. Then remaining all are outside liabilities it have. The difference between amalgamation in the nature of purchase and amalgamation in the nature of merger is, the main difference is, in case of amalgamation in the nature of merger, purchasing company will take over not only assets, but also liabilities, inclusive of reserves and surplus. One more time, I'm repeating. In case of amalgamation in the nature of merger, purchasing company will take over all assets and outside liabilities. Along with that, it will also take over the reserves and surplus of the selling company as well. Why, sir? You may have a doubt. Sir, amalgamation in the nature of merger, what really happens? Just selling company is feel that purchasing company is not an outsider. Just he is my brother. Just it is my sister concern. Just it is an extension to me. Who are all the shareholders exist in my company automatically becomes the shareholders of the other company, right? Then there is no difference between my company and the purchasing company. Then there is no difference between my assets, purchasing company assets. There is no difference between my liabilities, purchasing company liabilities, my profits as well as purchasing company profits. Whatever the assets, liabilities, and the profits in the form of surplus or the reserves we have, that all distributed by my shareholders as well as purchasing company shareholders. With that team, purchasing company is ready to take over the business of the selling company. If that is there in your back of mind, then along with assets and liabilities, purchasing company is also ready to take over the reserves and surplus of the selling company as well. That point you should need to remember in your mind. Now, the question is here, guys, sir, in the books of purchasing company, the entries doesn't change whether it is amalgamation in the nature of purchase, whether it is amalgamation in the nature of merger. Number one, the first and foremost entry is business purchase account debtor to liquidator of selling company at the rate of which amount, sir? PC. Is it PC will change based on method of accounting treatment in purchasing company books? No. There is no relation in between purchase consideration and the type of amalgamation. Irrespective of the type of amalgamation, PC will completely depending upon method of PC you are adopting. If it is lump sum method, then you may calculate in different mode. If it is under net payments method, you will apply the other scenario. If it is net asset value method, you will apply assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. If it is intrinsic value method, based upon intrinsic value per share, you will calculate. That's why, irrespective of the method of amalgamation, PC calculation doesn't change. Super. Number two, sir, I should need to incorporate assets as well as liabilities. Now I should need to incorporate all assets. I should need to incorporate all assets. All assets taken over at the rate of agreed value, book value. Can you please all of you come out through your query box? Is it I should need to incorporate an agreed value, book value, book value only, because which is amalgamation in the nature of merger. No need to check out the agreed value. That is, purchasing company is ready to take over all assets and liabilities set. Book values only, then only the amalgamation is said to be amalgamation in the nature of merger. To all the liabilities at the rate of book value. Along with all assets and all liabilities, it will also take over reserves and surplus of the selling company, which are reserves and surplus of selling company also taken over by the purchasing company. Am I right? Now it should need to compare with PC by cancelling the business purchase. Now my question is here, business purchase is nothing but PC, right? You are comparing net worth of the selling company with the PC. Net asset value of the business taken over, you are comparing with the PC. Am I right? Please all of you come here. If PC is here, NAV is here. Here, NAV is nothing but share capital of the selling company only. Do you agree with me? Here, NAV is nothing but share capital of the selling company only. Do you agree with me? Why, sir? Sir, what is the meaning of NAV actually? Assets minus liabilities, but it is merger. That's why along with liabilities, purchasing company also taken over reserves and surplus. Now, total of the assets minus outside liabilities minus reserves and surplus. The net balancing figure only share capital. That's why no need to compare assets with outside liabilities and reserves and surplus. You can directly consider share capital of the selling company, which is nothing but NAV of the business taken over in case of merger. Do you agree? That's why on behalf of NAV, I'll directly put here share capital of selling company. Now PC, based upon method of calculation, you may calculate the PC. Now let me give the different scenarios. Sir, purchase consideration is 10 lakhs, sir. Share capital of the selling company is also 10 lakhs, sir. Then there is no profit, no loss, nothing will happen to both the companies if PC is equal to NAV. Am I right? In the case of purchase method also, we've seen the same thing. If PC is equal to NAV, then there is no chance of occurring any capital profit, any capital loss as well. But here, let us assume PC doesn't equal to NAV. That is, PC doesn't equal to the share capital of the selling company. Then what should I need to do, sir? You should need to check, sir, PC is greater than share capital of the selling company? Or is it PC is less than the share capital of the selling company? For example, purchase consideration is 12 lakhs. Share capital of the selling company is still 10 lakh. Now, how much you excess paid? 2 lakhs excess paid. If this is the purchase method, simply such 2 lakhs, you may transfer to goodwill. I too agree. But this is not a purchase method. This is pooling of interest method. How the title was placed, pooling of interest method. Pooling of interest. Pooling of interest means for both the company interest, we should need to combine. We should need to pool. We should need to put together. That's why the name or the title is called as pooling of interest method. That means simply in case of amalgamation in the nature of merger, what really happens, simple line by line addition of assets of both the companies, liabilities of both the companies, including reserves and surplus. That is the reason why it is called as pooling of interest method. Okay, come back to this story. Sir, when the PC is paid more than the share capital of the selling company, what you are getting, then the excess of PC you are paid here, you can treat it as a revenue loss, not a capital loss. You can treat it as a revenue loss. Sir, who told, sir? AS 14 told. This is as per the provisions of accounting standard 14. This was not discussed by me. AS 14 clearly thrown some light on this issue. If the method of accounting treatment is pooling of interest method, then the purchasing company paid over and above the share capital of the selling company, then excess of PC paid over the share capital of the selling company, it should need to treat it as a revenue loss, and such loss should need to be nullified, or such loss should need to be set off with free reserves and surplus of purchasing company after taken over of reserves and surplus from selling company. Once again, I will repeat. The excess of PC paid over the share capital of the selling company should need to set off with free reserves and surplus of purchasing company after taken over of reserves and surplus from the selling company. Let us assume, please all of you concentrate, here the loss is 2 lakhs, right? Here two companies are there, one is selling company, another one is purchasing company. In purchasing company, reserves and surplus, it have general reserve for 50,000, let us assume. Profit and loss account, it have 30,000. Sir, statutory reserve or other capital reserve something. Statutory reserve, it have 2 lakhs. In selling company, if I check reserves and surplus, general reserve, it have, let us assume 1.5 lakh. So P&L, it have 50,000. Other statutory reserves, it have 60,000. Now this 2 lakh I should need to set off now. The 2 lakh revenue loss I should need to set off now. How I should need to set off, sir? First, acquire the reserves and surplus from the selling company. Now in purchasing company, after acquisition of reserves and surplus from selling company, how it will become? In purchasing company, in the reserves and surplus, you should need to consider only the free reserves. What is the meaning of free reserves, sir? Free reserves are those reserves and surplus which can utilize for distribution of dividend freely without having any restriction. Such reserves and surplus is known as free reserves. In generally, such free reserves are the general reserve and profit and loss account. Statutory reserves are not the free reserve. Those are the restricted reserves. As per the limitations provided in the statute, we should need to utilize such statutory reserve. Statutory reserve should not be useful for any other purpose. Even though capital reserve also will not be useful for any other purpose. Securities premium is also will not be useful for any other purpose as per the utilities provided in the Companies Act 2013. That's why all such reserves are not the free reserves. Those are the restricted reserves. So generally free reserves are only general reserve and P&L. Now, first in reserves and surplus general reserve, first you can consider existing selling company 50,000 plus you can take it from the existing purchasing company 50,000. You can take it from the selling company 1.5 lakh. Total it will become 2 lakhs. Now the loss occurred due to excess of PC over share capital of the selling company. How much? Loss due to excess of PC over the share capital of selling company is also 2 lakhs. You can nullify, then become nil. Then general reserve is become nil. Sir, if you want, you can make it set off with P&L on behalf of or instead of set off with general reserve. Do you understand? So that convenience is always be with you because both the general reserve and P&L both are treated as free reserves. So according to your discretionary thought process, either you can utilize general reserve or you can utilize P&L for making set off the loss arising due to excess of PC over the share capital of the selling company. Now what about the other reserves, sir? P&L, simple, add line by line, 50,000 plus 30,000. Just I'm adding completely 80,000. Next statutory reserves. Sir, here 60 plus here 2 lakhs, total 2,60,000. Like this simply you should need to show. That means the one and only difference here is in case of purchase method, the excess of PC over share capital of the selling company, we are treating as a goodwill, but here the excess of PC over share capital of the selling company, we are making set off with the free reserves of the purchasing company after taken over of reserves and surplus from the selling company. And one more thing, here NAV means share capital of the selling company. There NAV means assets minus outside liabilities. The two assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. That is another difference. Next, you can come to the other situation. Sir, if PC is less than the share capital of the selling company, if it is profit you should not treat it as a revenue profit. Profit you should treat it as a capital profit. Why, sir? Loss you are treating as a revenue loss, but profit you are treating as a capital profit. The reason is very simple. If you are treating this profit as a revenue profit, if you want to make it transfer to the P&L account at the general reserve, then certain profits are available for distribution of dividend. But that is not correct. This is not the profit which is readily available for distribution of the dividend. This is the profit you derived due to acquisition of business. So that's why if it is loss situation, you can set off with the free reserves. But if it is the profit situation, you should not add it to the P&L and general reserve. That's why PC less than share capital of the selling company, still you should need to continue to showcase as a capital reserve. So here there is no difference irrespective of the type of amalgamation. Whether it is amalgamation in the nature of purchase, then you are treating the difference as a capital reserve. Even though the amalgamation is in the nature of merger, still you are continuing to treating it as a capital reserve. Hope you understand the accounting treatment in comparison with PC with the share capital of the selling company. Now, accordingly, what you should need to do, sir, if you get the capital reserve, you can incorporate the capital reserve. No, sir, I'm not getting any capital reserve. I'm getting some loss, sir. Then out of the reserves and surplus of the selling company and the existing reserves and surplus of the purchasing company, out of which free reserves, from that free reserves, you can knock off the excess of PC over share capital of the selling company, then the remaining reserves and surplus of the selling company only you should need to incorporate in the books of the purchasing company. Hope you understand this point. Next, sir, after this entry, as usual, what are all other entries? That is liquidator of selling company account at are 2 equity share capital, 2 preference share capital, 2 securities premium, 2 debentures, whatever the case may be, accordingly you can issue. Then debentures of the selling company you may cancel, debentures of selling company, if at all, if you are taken over the liabilities of the selling company out of which debentures exist, then debentures of selling company should need to cancel. You can issue your company debentures, that is to 10% to 8% of your debentures. If it is issued at discount, debit the discount. If it is issued at premium, credit the securities premium. That's it. Sir, remaining all are as it is, there is no difference. That is, sir, for intercompany owings, is there any change? No change. That is always trade payables to trade receivables. Sir, for creation of stock reserve, is there any change in the journal entry? For creation of stock reserve, what is the entry we are in generally passing, guys? Goodwill account at R2. Tell me, guys, goodwill account at R2. Stock reserve is the entry we are passing, right? Sir, then here, what will be the entry for the purpose of creation of stock reserve, sir? For the purpose of creation of stock reserve, goodwill should not be debited. On behalf of the goodwill, you are always using P&L account or the general reserve. Again, the reason is same. Sir, you are paying excess over the existing asset worth. You know that. Am I right? You should need to decrease the stock value. If it is your stock, then what you should need to do? What you would may do? If it is really your stock, to decrease the valuation of the stock, you may write the pass entry P&L to stock reserve. The similar entry you should need to pass. Do you understand? Next, but one important thing here I want to highlight, concentrate. Sir, to maintain statutory reserves of the selling company in the books of the purchasing company, if it is amalgamation in the nature of purchase, you should need to provide one adjustment entry, which is amalgamation adjustment to statutory reserve. Do you remember this? When, if it is purchase method. Now the method is pooling of interest method. If it is pooling of interest method, can I continue to pass this entry amalgamation adjustment to statutory reserve to maintain statutory reserves of the selling company in the books of purchasing company? No. No need to pass. You know the reason? Sir, in case of pooling of interest method or amalgamation in the nature of merger, all the reserves and surplus of selling company will automatically become the reserves and surplus of the purchasing company. Then no need to maintain. Already the reserves and surplus of selling company will become the reserves and surplus of the purchasing company. Moreover, while comparing PC with share capital of the selling company, I am not disturbing the statutory reserves of the selling company. I am only utilizing the free reserves of the selling company or the free reserves of the purchasing company. That's why statutory reserves of the selling company as it is, I'm incorporating in the books of the purchasing company. That's why no need to pass any further adjustment entry to maintain the statutory reserves. That point you should need to remember. But if it is the purchase method, you should need to pass this adjustment entry for maintaining the statutory reserves. Then what is the overall theme in case of amalgamation in the nature of merger, sir? You should need to check only one thing. Yeah, whenever there is a problem asked from amalgamation in the nature of merger, you should need to calculate PC in the as usual mode. You should check the share capital of the selling company. Then if PC is greater than the share capital of the selling company, then the last you should need to set off with the free reserves of purchasing company and free reserves of selling company, after combinedly from which you should need to set off. If it is PC less than share capital of the selling company, directly you can credit it to capital reserve. Super. There is no change at all. And one more thing, sir, while presenting the balance sheet, what I should need to do, sir? You should need to do very simple task, line by line addition of assets of purchasing company, assets of selling company. No need to check over whether it is taken over at a grid value, whether it is taken over at more than book value, less than book value, like that. Because it is amalgamation in the nature of merger, all assets are taken over at book value. All liabilities are also taken out book value, line by line addition. Then reserves and surplus, how we should need to incorporate, it will depending upon PC less than share capital of selling company or PC greater than share capital of the selling company. But one thing you should need to remember, all reserves and surplus of the selling company should need to incorporate here. Is it okay? Then coming to the share capital, sir, existing share capital of the purchasing company plus how you are issuing the PC. If you are issuing the PC in the form of equity shares only possible, that's why you should need to raise the equity share capital to the extent of the PC. Then automatically balance sheet will be over. That is the reason why I told you amalgamation in the nature of merger is dead easy while compared with amalgamation in the nature of purchase. While doing problem in case of purchase method, lot of issues will coming into the picture at the time of presentation of balance sheet as well. At which value they are considered. Agreed value is how much? Do you understand? So such all issues and such burden are not exist in case of merger method or in case of pooling of interest method. If what are the things till now I discussed, if understood, then I can proceed with the problem. Let me check the query box right now. Fine. Sir, we have already distributed reserves and surplus of selling company to the shareholders. Then how purchasing company will take over it? It's good out actually. Guys, you should need to understand one thing here. Reserves and surplus just we are given to equity shareholders of selling company. That is equity shareholder books of accounts. Sorry, that is selling company books of accounts. Now we are in the books of the purchasing company. How the purchasing company will think I am telling you. Sir, is it really reserves and surplus? Is it given by selling company to the purchasing company? That doesn't happen. That doesn't happen. How the purchasing company will think is the matter of discussion here. How the purchasing company will think the reserves and surplus of the selling company, let us put into our books of accounts as well. One thing you are ignoring, sir. For example, if you are distributing the reserves and surplus to the equity shareholders of the selling company, the equity shareholders of the selling company will become equity shareholders of the purchasing company. Am I right or wrong, guys? If equity shareholders of the selling company will become the equity shareholders of the purchasing company, then whatever the reserves and surplus belongs to the equity shareholders of the selling company, the same reserves and surplus will also belongs to the equity shareholders of the purchasing company as well. Do you understand? That's why no confusion in that part. For the purpose of providing accounting treatment, how purchasing company will think, apart from the assets and liabilities, we are also taken over reserves and surplus. For that part, I am giving the PC. Do you understand? Like that purchasing company will think. There is nothing wrong in the purchasing company mindset. The reason is all the equity shareholders of the selling company will become the equity shareholders of the purchasing company. That's why whatever the reserves and surplus belongs to the selling company equity shareholders or the preference shareholders, the same is also equally applicable for equity and preference shareholders of the purchasing company as well. That is the reason why it will consider. Is it okay to all of you? Fine. Next. Sir, revaluation reserve will also become part of purchasing company. Every reserves and surplus, yeah. Not only the revaluation reserve. Every reserves and surplus of the selling company will automatically become the reserves and surplus of the purchasing company. Is there any further doubts? Before proceeding with the problem, please let me know quickly. Is there any further doubts, guys? Fine. There are no other doubts. Yeah. One more question that is important. At this stage, just I want to clarify. Sir, if the amalgamation, that is type of amalgamation, is amalgamation in the nature of merger, or if the type of amalgamation is amalgamation in the nature of purchase, based on that, is there any change in accounting treatment in the books of selling company? I mean, what I want to try to tell here, in selling company books, accounting treatment will change based upon type of amalgamation in the books of purchasing company. If it is purchase method, one type of accounting treatment. If it is pooling of interest method, another type of accounting treatment. Shall we need to adopt? One thing first you should need to clarify from your side. Sir, in the books of selling company, AS 14 doesn't applicable. Then AS 14 doesn't applicable means why you are thinking about which method of amalgamation they are going to adopt in the books of purchasing company. Irrespective of the method of amalgamation, in the books of selling company, The accounting treatment is 5-step approach simply by following the gap. Simple closure of books of account you should need to adopt. There is no change at all. Is it okay to all of you? Fine. Next, one more important clarification. This is for examination purpose, not for the real-time scenario. Sir, in the exams, in problems, while resolving the problems, whether they can clearly given the type of amalgamation or not, sir. That is the question you may have in every student mindset, in every student mind. If at all the type of amalgamation is clearly mentioned, please all of you complete the problem according to the given type of amalgamation. If they clearly mention, resolve this problem based on the assumption that amalgamation in the nature of merger, sir, then complete the problem in that mode only. If they are given, sir, amalgamation in the nature of purchase, then please all of you complete the problem in that particular method only. Another scenario, sir, method, which method you should need to adopt, they are not provided any information, sir. But what they told in the problem itself, they clearly told that identify the method and accordingly resolve the problem. If at all like that, they are asking the question, what the examiner expectation is, you should need to identify which method is possible. Accordingly, you should need to resolve the problem in that particular method. Then apply the 5 rules. That is, when amalgamation is said to be amalgamation in the nature of merger and amalgamation in the nature of purchase. Such 5 points are there now. Apply such 5 points. If it is applicable, then merger. Otherwise, purchase method. Accordingly, you can decide and resolve the problem. Next. Sir, no method was mentioned, but the information not given in this way. I mean, identify which method is applicable. Like that, not at all given, sir. Like that, not at all given, sir. And the problem information is also create a lot of ambiguity, sir. It is suitable for amalgamation in the nature of merger as well as amalgamation in the nature of purchase. We can't tell in that much of easy mode, because if you know the practical situation, then you can easily identify that whether the amalgamation is amalgamation in the nature of merger or amalgamation in the nature of purchase. The entire information is given, just simply given one more, that is entire balance sheet information is given, one line just they added below the balance sheet information. Shareholders of the selling company or the equity shareholders of the selling company will get for every equity share 2 equity shares from the purchasing company. That is the only thing was given. Then how you can decide the method of amalgamation? Sir, is it amalgamation in the nature of merger? You can able to decide. Is it amalgamation in the nature of purchase? You can able to decide. We can't decide in that much of easy mode. At that particular scenario, there is ambiguity in the from the information given. Then took assumption. If it is, I assumed that, or if it is amalgamation in the nature of purchase, if it is amalgamation in the nature of merger, or I assumed that the amalgamation is amalgamation in the nature of merger, or I assumed that the amalgamation is amalgamation in the nature of purchase. Accordingly, you can resolve the problem. But most of the times, what I observed from my past experience, maximum number of cases, they completely provided the information with respect to type of amalgamation. But if at all, if you want to test, then he will clearly provide the information that identify the type of amalgamation. Then the base points will also be given for such identification. Sir, there is no information and ambiguity exists, sir. Then if you feel like that, then at that point of time, take the assumption and resolve the problem. Is it okay to all of you guys? Okay. Next. Jyoti. Jyoti is asking one question. Sir, absorption is amalgamation in the nature of merger. Again, you are confusing, guys. Sir, whether it is amalgamation, whether it is absorption, whether it is internal reconstruction, all are same. Whether it is in the nature of merger or whether it is in the nature of purchase, you should need to decide based upon such 5 conditions. In amalgamation, what happens? 2 companies liquidate, one new company will incorporate. In absorption, one existing company is taken over another existing company. In internal reconstruction, a new company is incorporated to take over another company. That is only difference for incorporations and a number of companies involved and new company, existing company. That is the only difference. But for the purpose of deciding the accounting treatment in the books of purchasing company, whether it is amalgamation problem, whether it is absorption problem, whether it is internal reconstruction problem, I doesn't differentiate. I should need to check only one thing, whether purchase method is applicable, pooling of interest method is applicable. Do you understand? Okay, fine. In today's class, we are going to see certain problems based on amalgamation. We may see certain problem based on absorption. If 3 companies are involved, you can take it as amalgamation. I will not specify as well. So this is amalgamation, this is absorption. Like that, I will not specify. Do you know the reason? It doesn't create any difference in accounting treatment, whether it is amalgamation, absorption, internal reconstruction. I should only check 2 things. What are the selling companies? What are the purchasing companies? Accordingly, I will provide the accounting treatment. Then why not I should need to think whether it is amalgamation, absorption, or internal reconstruction. Okay, fine. So without wasting much time, let me entering into the problem. Problem number. Let me take the problem based on merger. Please all of you come to problem number 9. Quickly, guys. Yeah, sorry. External reconstruction. I'm wrongly used the word internal reconstruction. I'm so sorry, ma. Janice. Our next chapter is internal reconstruction, na? That's why internally such internal reconstruction word was stored in my mind. Sorry. Yeah, guys, before proceeding with the problem, one last time, please all of you respond. So till now, what we have discussed in this chapter, do you have 100% clarity? Quickly, guys. Quickly, all of you, before proceeding with the problem. Yes, sir, we're absolutely fine. Just we will make it practice, then we can enjoy the entire amalgamation concept, sir. If that is the thing, please all of you put your thumbnails, yes, sir, something like that. Quickly, guys. Yeah, clear. Fine, super. Yeah, concentrate then on problem number 9. Consider the following summarized balance sheets of X Limited and Y Limited. 2 companies are there. Under assets, land and building is given. Plant and machinery is there. Furniture and fittings, investments, inventory, trade receivables, cash and bank. And come to liabilities part. Equity share capital is there. 14% preference share capital is there. So equity shares face value 10 rupees. Preference shares face value is 100 rupees. General reserve is given. Export profit reserve, which is statutory reserve. Sir, how to identify the statutory reserve, sir? What are all the known reserves except that any unknown reserve is there? You can call it as a statutory reserve. You may not identify or you may not know all the statutory reserves names. That's simply how you should need to identify. If you exclude all unknown reserves at a single place, which will become the statutory reserve. Okay. Investment allowance reserve, which is also a statutory reserve. We don't know actually such reserves. That's why simply I make it treated as a statutory reserves. P&L account is a free reserve. General reserve is a free reserve. Next, 13% debentures were given, face value 100 each. Trade payables are there. Other current liabilities given. X Limited takes over Y Limited. X Limited takes over Y Limited means X Limited is a purchasing company. Y Limited is a selling company. On 1st April 2011, which is date of amalgamation, X Limited discharged the purchase consideration as below. Issued 3,50,000 equity shares of rupees 10 each at par to the equity shareholders of Y Limited. Okay. Issued 15% preference shares of 100 rupees each to discharge the preference shareholders of Y Limited at 10% premium. Can you please all of you tell me at this stage method of PC quickly before calculating the amount of PC? First, all of you let me know what is the method of PC I should need to adopt here. Still, I am not getting any answer. Quickly. Is it NAV? Is it net payments method? Is it a lump sum method? So many persons asked such doubts before startup of all these things. Sir, how to identify the method of PC while resolving the problem? Now this is the testing time for your knowledge. Which method of PC I should need to adopt? No one is providing any answer here. Quickly. Is it delay or I mean something that's not your problem, or this delay? Yeah, super. Now I got all the answers. Net payments method, sir. Yes, it's absolutely correct, which is net payments method. Because from the information given in the problem, you can able to ascertain how much amount you can payable to the equity shareholders of the selling company, how much amount you can able to pay to the preference shareholders of the selling company. If that is the case, then the method of PC is net payments method. Am I right? Sir, irrespective of the type of amalgamation, PC calculation is same, right? So first, what I should need to do, let me calculate PC in my OneNote quickly without reading any further information. Problem number 9. Calculation of PC. In bracket net payments method. Now, how to calculate the PC here? Particulars, amount rupees, amount payable to equity shareholders first. We are issuing, we means purchasing company, 3,50,000 equity shares of rupees 10 each at par. So simply 3,50,000 equity shares at the rate of 10 rupees each means, which is equal to 35 lakhs. Next, to preference shareholders. Okay, that is 14% is preference shareholders. That is to 14% is preference shareholders of selling company. What we are issuing here? We are issuing 15% is preference shares of rupees 100 each to discharge the preference shareholders of Y Limited at a 10% premium. Sir, discharging with premium. We are issuing our shares with face value only, but we are discharging the existing preference shareholders of the selling company with a 10% premium. Sir, discharging at 10% premium means go to the selling company, which is X Limited. Here it is 22 lakhs is there. If you are discharging with 10% premium means you are going to settle at the rate of 110%. Now 22 lakhs into 110% means how much, which is? Sorry, this is X Limited, na? I should need to work out for Y Limited. Which company is purchasing company? X Limited is a purchasing company, Y Limited is a selling company. I'm so sorry, go to the Y Limited. So 17 lakhs. Here it is there now, 17 lakhs into 110%. You should need to discharge the preference shareholders of the selling company. Y Limited is a selling company, X Limited is a purchasing company. Now, how much I should need to discharge? 17 lakhs into 110%, which is 18 lakhs 70,000. Am I right? So you can go to the working note. 18,700. 15% preference shares at the rate of 100 each. How you are getting that? 17 lakh into 110%, you are getting 18 lakh 70,000. 18 lakh 70,000 divided by 100 rupees means, which is 18,700 preference shares only. That is 18,700, 15% is preference shares at the rate of 10 rupees each, which will become 18 lakh 70,000. If you can add 35 lakhs plus 18 lakh 70,000, total is how much, guys? PC. 53 lakh 70,000. Am I right, guys? All of you? PC is 53 lakh 70,000 only. Yes, super. We are not yet read anything. We directly went to the calculation of PC. First, let me check the further information. The debentures of Y Limited, that is the debentures of selling company, will be converted into equivalent number of debentures of X Limited, because after taken over of assets and liabilities of the selling company, after incorporation of the debentures of the selling company, we should need to cancel, we should need to issue our own company debentures. Sir, how I should need to cancel the debentures of selling company, sir? You should need to cancel with the face value only, because there is no change in the face value. If you check Y Limited company debentures, here it is 13% debentures we have. For this 3,50,000, we are also issuing the equivalent number of debentures with the equal face value. You can cancel the 13% debentures of the selling company. You can issue your own company debentures. That's it. The statutory reserves of Y Limited are to be maintained for 2 more years. If you observe, 2 different statutory reserves we have. One is export profit reserve, investment allowance reserve. As per their statutes, such reserves should need to be maintained for 2 more years. Show the balance sheet of X Limited after amalgamation on the assumption that the amalgamation is in the nature of merger, the amalgamation in the nature of purchase. Sir, this is a clear-cut problem which explains the difference between pooling of interest method and the purchase method. That is the reason why I'm picking this problem for the discussion. Is it okay to all of you? No need to provide any journal entries. You can directly work out the balance sheets under both the methods. But before working out such balance sheets, the required information you should need to work out in the working notes. Now, first all of you, please concentrate on the first point. That is first one. If the amalgamation is amalgamation in the nature of merger. We already calculated the PC, right? Now, before going for balance sheet, what I should need to check, I will compare purchase consideration with NAV. That is whether I am getting profit or loss on business taken over. On business taken over from X Limited, from Y Limited, sorry, selling companies Y Limited. Now tell me, PC you already calculated. How much you got the PC? 53 lakh, 70,000. Sir, if the amalgamation is amalgamation in the nature of merger, then net asset value is nothing but share capital of the selling company, na? Then come here, no need to compare assets and liabilities. No need to reduce assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. Such and all things directly NAV of the business taken over is nothing but share capital of the selling company. In Y Limited, the share capital is how much? 30 lakhs plus 17 lakhs, which is equal to 47 lakhs. Now, can you let me know, guys, all of you, is it the situation PC is greater than NAV, right? Or the PC is greater than share capital of selling company? If PC is greater than share capital of the selling company, then which is a clear-cut loss situation, then the excess of PC should need to set off with free reserves and surplus of purchasing company after takeover of reserves and surplus from selling company. Now the loss is how much? Excess of PC is how much? Which is 6,70,000. The only one thing you should need to remember is this 6,70,000 you should need to set off with free reserves. Am I right? With this background, let us go for the preparation of balance sheet. All of you come here. Now balance sheet of X Limited. Balance sheet of X Limited. In bracket after amalgamation. Okay. So first you can start with, here it is liabilities, sorry, equity and liabilities. Under that, just a moment. Here I will start equity and liabilities. Under that, shareholders fund, share capital. You actually need to provide note number 1, but I don't want to provide any note numbers. Just I will make it work out here itself to save my time. But in the examination, all of you please open your notes, or simply I'll put notes to balance sheet here. That is number 1. Now existing share capital in X Limited, how much? All of you let me know. Existing share capital, equity share capital 50 lakhs. This is share capital. Equity existing, how much? 50 lakhs. 1 second. Now our company issuing in the form of equity shares 3,50,000 at the rate of 10 rupees each means 35 lakhs, which is issued as PC. Na? The 35 lakhs you should need to add here. 35 lakhs that is issued as PC in the form of equity shares. Now 35 plus 50, 85 lakhs in the form of equity shares. Now in the form of preference shares, all of you, existing preference share capital, 14% preference share capital is at 22 lakhs. 14% preference share capital is at 22 lakhs. Again, issued as PC, we are issuing PC as 15% preference shares, which is 18,70,000. If you have any doubt, you can cross verify, guys, which is 18,70,000. Here itself, it is given 18,70,000. Okay. Now make it total. You will get the preference share capital 22 plus 18,70,000, which is equal to 40 lakhs 70,000. Make it total equity plus preference. Total how much? 85 lakhs plus 40 lakhs 70,000, which is 125 lakhs 70,000. 125 lakh 70,000 is the share capital. Next, come to reserves and surplus. Come to note number 2. So this is note number 2, guys. Reserves and surplus. Concentrate, all of you. Sir, all the reserves and surplus of the selling company will become the reserves and surplus of purchasing company. Na? Now, first come to general reserve. Come to general reserve, first reserve. Sir, existing opening X Limited, how much? 5 lakh. That is for X Limited general reserve is given at 5 lakh. Now you can add the general reserve of Y Limited, which is at 2,50,000. So total how much I got here? 7,50,000. Now it is clearly given that we are paying the PC excess of share capital of the selling company. The loss, how much we got? 6,70,000. Such 6,70,000 you should need to set off with the reserves and surplus of the purchasing company after taking over of reserves and surplus from the selling company. Now, can I able to set off that 6,70,000? Yes, you can able to set off. That's why loss due to business takeover. Loss due to business takeover 6,70,000. Now, how much general reserve I can able to show in the balance sheet? 7,50,000 minus 6,70,000, which is equal to 80,000. Remaining all reserves line by line addition. Remaining all reserves means come to export profit reserve. Export profit reserve. So directly I am just adding 3 lakhs plus 2 lakhs. 3 lakhs plus 2 lakhs, which is 5 lakhs. Directly I am adding simply. Next, investment allowance reserve. X Limited doesn't have, it only have the Y Limited. You can directly show the 1 lakh. Next, P&L account, add line by line addition, 7,50,000 plus 5, 12,50,000. Now you can add the total of reserves and surplus. 5 plus 1, 6, 6 plus 12,50,000, 18,50,000, 18,50,000 plus 80. Is it 19,30,000? Please let me quickly check once again. 80,000 plus 5 lakhs plus 13,50,000. Yes, it is 19,30,000. You can place the same here, 19,30,000. Sir, what about remaining all assets and all liabilities, sir? Please come here, guys, all of you. Remaining all assets and liabilities, no need to think anything without having any second thought. Simple line by line addition. Simple line by line addition. That's it. If you come for 13% debentures, let us assume that is long-term borrowings are under first non-current liabilities. Under non-current liabilities, if you come for long-term borrowings, simple line by line addition, 5 lakhs plus 3,50,000, 8,50,000, which is for debentures. Next, for current liabilities, a trade payable. So trade payable 4,50,000 plus 3,50,000, how much? 8 lakhs, right? Simple line by line addition. Next, other current liabilities, 2 lakhs plus 1,50,000, 3,50,000. So if you make the total, you will get the total of equity and liabilities. Then you can come under assets. Sir, I don't want to add single line by line. I will check the totals just for the time being. In the examination, please put it into the respective head. 99 plus 66, how much? All of you, 99 lakhs plus 66 lakhs, total 165 lakhs, right? So sundry assets, I'm putting 165 lakhs. Please, all of you make total of the equity and liabilities quickly. 125 lakh 70,000 plus 19 lakh 30,000 plus 8 lakh 50,000 plus 8 lakhs plus 3 lakh 50,000. I got 165 lakhs exactly. If you want, you can cross verify. Assets all line by line addition, na? Simple. Book values only. That's why I make it total the sundry assets. But in the exam, in the respective head, please all of you make it present. Just to finish the problem quickly, just I make it total here. Guys, now let me know which problems are easy. Amalgamation in the nature of merger, amalgamation in the nature of purchase. In purchase, what is there? NAV, no need to calculate. Directly, you can consider the share capital of the selling company. While presenting the balance sheet, you can put your efforts for only for presentation of share capital as well as reserves and surplus. Remaining all assets and liabilities, simple line by line addition. That is the reason why I told you, if at all any problems asked in case of amalgamation in the nature of merger in the exams, so the problem is dead easy. You can take very less efforts to complete the entire problem. That's it, guys. Sir, one thing I want to highlight here. To maintain the statutory reserves of the selling company, can I provide any adjustment entry like amalgamation adjustment to statutory reserve in the amalgamation in the nature of merger? No. The same problem after the break. The same problem after the break. We are going to resolve on the assumption that amalgamation in the nature of purchase. Then what will be the impact? How it is different from pooling of interest method? Let us have a look. All of you please go for the break. And after the break, I will start with amalgamation in the nature of purchase method for the same problem. let us resolve the same problem on the assumption that amalgamation is amalgamation in the nature of purchase. Sir, first of all, there is no change in PC. The same PC you can consider. How much PC you got? 53,70,000. Just a second. One of our friend asked one question. Actually, I didn't see. I realized that question in the break. The point is, it is not a big doubt actually. Sir, how the payment related to preference shareholders, you got 18,70,000. That's dead easy, Amma. You should need to go by the point what he is given. Issued 15% preference shares of 100 each. Now, each and every preference share, whatever you are issuing, that resembles 100 rupees face value. To discharge the preference shareholders of Y Limited at 10% premium. From here, you should need to break the sentence. To discharge the preference shareholders of Y Limited at 10% premium means you are going to discharge the preference shareholders of selling company by paying 10% in excess over the face value. Now, always in the balance sheet, the preference share capital is shown at face value. You are paying in excess of 10% means you are paying 18,70,000. Like that, we are going to decide. Hope you understand right now. Now, 18,70,000, but the preference share, whatever you are issuing, it is 100 rupees face value only. That's why the number of preference shares you are going to issue is 18,700 preference shares. Am I right? Fine. Now let me continue the story, guys. Come back here. Come down. Just a moment. I log out my query box. Just a moment. Let me log in quickly and then we'll continue. Otherwise, I may not have control on the class. Yeah, I log in. I'm with you. Fine. Concentrate. Sir, PC is 53,70,000. Super. Now, to work out the balance sheet, first, what should I need to think? I should need to compare PC with NAV because I should need to know whether I derived goodwill or capital at this stage. So purchase consideration is 53,70,000. Now all of you let me know NAV is how much? How I should need to calculate NAV? Net asset value is nothing but assets taken over at the rate of agreed value less liabilities taken over at the rate of agreed value. But it doesn't include reserves and surplus. Now what are the total assets taken over at the rate of agreed value? Which is 66 lakhs. All assets we are taken over at a book values only. Sir, what are the different liabilities we are taken over? This is the liabilities portion. Am I right? Now 66 lakhs minus 3.5 plus 3.5 plus 1.5, that is 8.5. If you reduce 66 minus 1.5, simply NAV is sundry assets. Total how much you got? 66 lakhs less sundry liabilities. How much you got? 3.5 plus 3.5 plus 1.5, which is 8,50,000. Then you will get NAV of the business taken over. How much, guys? NAV of the business taken over? 66 lakhs minus 8,50,000, which is equal to 57,50,000. Now let me know all of you. PC is 53,70,000. NAV is 57,50,000. Is it PC less than NAV or PC greater than NAV? PC is less than NAV. Am I right? PC is 53,70,000. NAV is 57,50,000. That's why PC is less than NAV. Sir, whatever the purchase consideration paying is less than the business worth what you are getting, then this situation will leads to capital reserve. So the difference is how much for capital reserve? Capital reserve here I get 3,80,000, the difference. Now, at the time of presenting the balance sheet, so balance sheet of X Limited, in bracket, that is purchase method, right? Again, start with equity and liabilities. Under that, shareholders fund, A share capital. A is share capital. Now, coming here, X Limited existing share capital, you know, which is 5 lakhs. Now X Limited is going to issue equity as well as preference shares to selling company. So that means whether it is amalgamation in the nature of purchase, whether it is amalgamation in the nature of merger, there is no difference in share capital. Because the existing share capital of X Limited doesn't change. And the amount of PC also doesn't change. That's why there is no change in share capital. You can consider the same share capital. How much share capital earlier you got? 125 lakh 70,000. No need to work out once again. Put the same share capital, which is 125 lakh 70,000. Do you agree with me, all of you? Come to reserves and surplus. So reserves and surplus, let us work out in separate note, which is note number 1 here, reserves and surplus. Sir, here line by line addition of reserves and surplus doesn't work out. Only reserves and surplus of X Limited you should need to consider. Reserves and surplus of Y Limited you should not consider. So general reserve of your company is how much? 5 lakh. So you can take your own company general reserve, which is for 5 lakh. Next, export profit reserve. Sir, I need to consider Y Limited export profit reserve as well. The reason is investment allowance reserve and export profit reserve both are statutory reserves. Now it is clearly given in the problem that, sir, the statutory reserves of Y Limited are to be maintained for 2 more years. That's why I should need to pass one entry. The entry is amalgamation adjustment account debtor to export profit reserve to investment allowance reserve. Export profit reserve of selling company, how much? 2 lakhs. Investment allowance reserve, how much? 1 lakh. Total amalgamation adjustment, how much? 3 lakhs. So now export profit reserve, this 2 lakhs and the existing 3 lakhs. Total how much? It will become 5 lakhs. So export profit reserve, you can consider for 5 lakhs. Investment allowance reserve, you can consider for 1 lakh. Next, profit and loss account, 12 lakh 50,000. Not yet over. Amalgamation adjustment account. Negative balance, you should need to show 3 lakhs. Yes. Still not yet over. Sir, while comparing PC with NAV, you derived capital reserve. Na? Such capital reserve where I should need to show? Under reserves and surplus only. So capital reserve you should need to show, which is at 3,80,000. So presentation of reserves and surplus plays the crucial role here. Now let me know the total reserves and surplus. 5 lakhs plus 5 lakhs plus 13 lakh 50,000 minus 3 lakhs plus 3 lakh 80,000. 24 lakh 30,000. So reserves and surplus, I got 24 lakh 30,000. Correct? Let me know, guys. Is it correct or wrong? No one is providing any answer here. Yes, at least one person, please let me know quickly. Is it computation part is correct? Is it right? Can I go further? Still I am waiting for your answer, guys. Now, sir, what about the other issues, sir? What about the other issues means liabilities? Simple line by line addition, guys. Other liabilities, I don't want to make it present. Other liabilities, simple line by line addition. Then coming to assets, sir, assets were also simple line by line addition. Simple line by line addition. Because even though the amalgamation is amalgamation in the nature of purchase, what we are doing here, we are acquiring the selling company assets as well as liabilities at book values only. So that's why you can directly consider the the assets as well as liabilities at book values. That's why simply line by line addition of assets and liabilities, if you made it, then automatically the balance sheet is going to tally. I don't want to make it present. If you require, you can take it as a HW presentation. Okay, these only the important things. Up to this I completed. This is all about problem number 9. Sir, amalgamation in the nature of purchase, I am giving as HW. Okay. I considered P&L of Y Limited. Someone is telling that, sir, you considered P&L of Y Limited. Then you can consider X Limited. Okay, which is only P&L 7,50,000. Yeah, I wrongly considered. So please consider the correct values. Accordingly change it, guys. Reserves and surplus. Remaining all are correct. General reserve 5 lakhs, exactly correct. Export profit reserve 3 plus 2, 5 lakh, exactly correct. Investment allowance reserve, I considered 1 lakh, correct. Then one second. P&L. So profit and loss account, please consider only for X Limited, which is for 7,50,000. Don't consider for Y Limited. Okay, super. Then amalgamation adjustment account 3 lakhs negative. Then capital reserve, I got 3,80,000. Please all of you make it change accordingly. Sorry, I considered both the companies P&L. That's wrong. Okay. Now how much you got, guys? 5 lakhs plus 5 lakhs plus 1 lakh plus 7,50,000 minus 3 lakhs plus 3,80,000. Yeah, it's 19,30,000. Someone is observed. What about all other friends? Yeah, I committed mistake, but no one is telling. Only one person observed. So which is 19,30,000. Anyway, that's fine. Okay, remaining all, please all of you take care, guys. I don't want to concentrate on the remaining other liabilities and assets. Now, let me resolve one examination problem, guys. Go for problem number 11. All of you please come to problem number 11, which is January 2021 question, actually, which was asked in Jan 2021. Jan means which is actually November written. At that point of time, due to COVID and all other issues, you know, the examinations were postponed for 2 to 3 months like that. That's why examinations were held in the month of Jan. So now come here. Galaxy Limited and Glory Limited are two companies engaged in the same business of chemicals. Okay. To mitigate their competition, a new company, Glorious Limited, if you observe, which is a pure amalgamation, a new company is incorporated to take over the existing company to mitigate the competition. That's why which is a pure amalgamation, is to be formed, to which the assets and liabilities of both the existing companies, with certain exception, are to be transferred. What are such exceptions? We don't know. They might given below. The summarized balance sheet of both the Galaxy and Glory Limited as at 31st March 2020 are as follows. So both Galaxy and Glory are selling companies, and the Glorious Limited is purchasing company. Now the selling company's information is given. Under equity and liabilities, shareholders fund, share capital is given. Equity shares of rupees 10 each, 8,40,000, 4,55,000. Under reserves and surplus, general reserve is there, P&L is there. Come here, non-current liabilities. Secured loans, 6% debentures was given. Then you can come to current liabilities, trade payables is given. This is the information related to liabilities and share capital. Come to assets. Under non-current assets, PPE, freehold property was given. Plant and machinery less depreciation was given. Motor vehicles less depreciation given. Total 3 different PPE are given. Then come to current assets, inventory, trade receivable. Cash at bank is the final component. Assets and liabilities are to be taken at book value with the following exceptions. So, except the below, remaining all assets and liabilities are taken over at book value. That is the intention. The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. The debentures of Glory Limited are to be discharged by the issue of 8% debentures of Glorious Limited at a premium of 10%. What is the meaning of this sentence, guys? All of you, please understand. Discharged for this sentence was breaked. By the issue of 8% debentures of Glorious Limited at a premium of 10% means whatever the debentures issued by the purchasing company, they are issuing at premium. Issue at a premium. Discharge at par. If you check the same sentence in the last problem, the last problem means where the problem is, just a moment. Somewhat one person asked that question. Yeah, that is related to preference shareholders. Please concentrate. This is related to preference shareholder. How the sentence they given? Issued 15% preference shares of 100 rupees each to discharge the preference shareholders of Y Limited at 10% premium. If the premium component was given along with discharge, then discharge is with premium, then issue is at par. Here, issue at par, but discharge with premium. Do you understand? Whatever the existing face value of the preference shareholders, we are paying in excess of 10%. But the issued preference shares are, we are issuing at the rate of face value. This is the meaning of sentence in that problem. But coming here, that is exam problem, come down, what he is given, the debentures of Glory Limited are to be discharged. That's over, sentence is over. If nothing is mentioned, at which price we are discharging, sir? We are always discharging as face value, nothing was mentioned. That's why discharge is at par. By the issue of 8% debentures of Glorious Limited at a premium of 10%. Your issue is at a premium. Fine. Plant and machinery of Galaxy Limited are to be valued at rupees 2,52,000. Okay. Goodwill is to be valued at Galaxy Limited 4,48,000 and Glory Limited 1,68,000. Okay, fine. Liquidator of Glory Limited is appointed for collection from trade debtors and payment to trade creditors. He retained the cash balance and collected 1,10,000 from debtors and paid 1,08,000 to trade creditors. Liquidator is entitled to receive 5% commission for collection and 2.5% for payments. The balance cash will be taken over by the new company. So this is the important point which decides which assets and liabilities taken over by the purchasing company. If like that any new point was asked in the exam, suddenly you thought that, sir, nowhere our faculty teaches this. Nowhere we prepared this. Don't think like that. So maybe the terms and conditions entered in between purchasing company and selling company, no one can guess. In the universe, the terms and conditions are abundant. So based upon their discretionary thought process, they will agree the terms and conditions in between purchasing company and selling company. Just we should need to understand the terms and conditions. Really what happened, you should need to check. But each and every terms and condition, no one can teach now. You should need to adopt your mindset. You should need to apply your mindset into that particular situation. You should need to understand that particular term. Accordingly, you should need to work out. Now, what is given here? Liquidator of Glory Limited. Liquidator of Glory Limited means out of the existing two selling companies, he is talking about one selling company, which is Glory Limited. Okay. Now, for each and every selling company, a liquidator is appointed. Now he is talking about liquidator of Glory Limited is appointed for collection from trade debtors. Sir, if liquidator is going to collect amount from trade debtors means the trade debtors of Glory Limited is not taken over by the purchasing company. Do you agree? The debtors is not taken over by the purchasing company. And the payment to the trade creditors of Glory Limited is also not taken over by the purchasing company. Sir, is the same situation is also applicable to Galaxy Limited as well? Two companies are there, na? One is Galaxy, na? Galaxy, there nothing was prescribed. Nothing was given means for the Galaxy Limited, debtors and creditors is taken over by purchasing company. But for Glory Limited, debtors and creditors was not taken over by the purchasing company. The debtors and creditors is ultimately settled by the selling company liquidator himself. Okay. He retained the cash balance. He means liquidator. Liquidator will retain the cash balance on his hand. How much cash balance is there in the Glory Limited? 1,04,000. Okay. Existing cash balance is 1,04,000. And collected rupees 1,10,000 from the debtors. When he collected money from the debtors, now cash with the liquidator will increase. And paid rupees 1,80,000 to trade creditors. If he settled 1,80,000 to trade payables, then the cash balance is going to decrease. And liquidator is entitled to receive 5% commission for collection and 2.5% for payments. That is liquidator remuneration. Liquidator remuneration is 1,80,000 into 5% plus, sorry, 1,10,000 on that 5%. 1,80,000, 2.5%. 1,80,000 into 2.5% plus 1,10,000 into 5%. Now, if you check, you will get the liquidator remuneration, how much it is. Please, all of you calculate and let me know. 1,10,000 into 5%, which is 5,500. This component is 5,500. This component is 4,500. Total 10,000. Now, how much cash balance is available with the liquidator? Can you verify quickly? 1,04,000 plus 1,10,000 minus 1,80,000 minus 10,000. So after making all these payments with the liquidator, how much cash balance is available, sir? 24,000 cash balance is available. Now the balance cash is 24,000 will be taken over by the new company. Taken over by the new company means purchasing company. Now what the conclusion is? Debtors and creditors is not taken over by the purchasing company. The cash balance, the existing cash balance of 1,04,000 not transferred to the purchasing company. After settling with debtors as well as creditors and the existing cash balance put together, liquidator will end up with 24,000 cash balance. Such 24,000 is only taken over by the purchasing company. This is only applicable for Glory Limited. For Galaxy Limited, all assets taken over, all liabilities taken over, including creditors and debtors as well. Fine. You are required to compute the number of shares to be issued to the shareholders of Galaxy Limited and Glory Limited, assuming the face value of each share in the Glorious Limited is 10 rupees. Prepare balance sheet of Glorious Limited as on 1st April 2020 and also prepare the notes to the accounts as per Schedule 3 of the Companies Act 2013. Now, my first question is, in the exam problem, is there clearly mentioned the method of amalgamation? They're not mentioned. They're not mentioned. They're not given. Then what you should need to check? Whether we can able to decide the method of amalgamation without having any ambiguity. Yes, we can able to decide, because purchasing company is not taken over some of the assets and liabilities of the selling company. If all the assets and liabilities not taken over, then you can straight away decide amalgamation is amalgamation in the nature of purchase. Yes, we can able to predict the method of amalgamation. That's why no need to take the assumption here. You can directly go with amalgamation in the nature of purchase. Not like that, sir. From the given information, we can unable to predict the method of amalgamation. There is a choice of action, whether we can able to presume it is amalgamation in the nature of merger as well as amalgamation in the nature of purchase, then took assumption, based on assumption resolve the problem. Do you understand? Fine. Come to my OneNote quickly, all of you. So method of amalgamation is purchase method. So before doing all such things, what should I will need to do? Here the problem is only related to calculation of PC and the preparation of balance sheet. Why I'm telling it is calculation of PC. Here they are asking how many number of shares to be issued to the selling company. If you know the PC, then if it is divided with 10 rupees, then you will get how many number of shares issued as PC. Number of shares issued as PC, they are asking in point number A. In point number B, they are asking prepare the balance sheet in the books of the purchasing company. These are the two questions they are asking. For that, first of all, you should need to know one thing, guys. What is the problem number 11? You should need to know one thing. PC you should need to calculate. PC you should need to calculate. Now my question is, which method of PC is applicable here? Which method of PC is applicable here? All of you please reply with your answer. If you are able to think in the right direction, then you can definitely give a good answer in the exams, no doubt. Which method of PC? Method of amalgamation we decided. That is amalgamation in the nature of purchase method. Method of PC, please decide, all of you. Yeah, some of our friends, they are telling NAV. Only one friend is telling which is net payments method. Sir, when you can able to apply the net payments method, let me know, all of you, why you are confusing. From the given information, you can able to ascertain how much amount payable to the equity shareholders of the selling company and preference shareholders of the selling company. Then you can apply the net payments method. Nowhere it is mentioned how much amount is payable to equity and preference shareholders of the selling company. Then how you can able to apply the net payments method? Then the only method available is net asset value method only, because even intrinsic value per share is also not available. That's why you can straight away apply net asset value method. Like this, you should need to think from your side, inner side. No one will tell in the exams. You should need to think what happens. Net payments, let us check, not applicable. Then go for NAV. Is it intrinsic value method is possible? Not possible. That's why go for NAV method. Now computation of PC under NAV method. So total 2 companies are there. Particulars, Galaxy, Glory. Start with assets. What are all different assets taken over at the rate of agreed values? Assets taken over at the rate of agreed values. Now come here, come to the assets one by one, all of you. So only plant and machinery is only taken over it other than the book value. Remaining all assets are taken over it book values only. Apart from that, if you observe, one more asset, goodwill, is also there. So certain goodwills is also taken over by the purchasing company. What are all different assets taken over? All assets I should need to consider. I may forgot. First, let me start the problem with goodwill itself. Out of the all assets, first let me start with the goodwill. Goodwill of Galaxy is given at 4,48,000, and for Glory, which is given at 1,68,000. Now remaining assets you can check one by one through balance sheet. So come to the PPE. Come to PPE. Out of the PPE, freehold property. So nothing was given means at book values only 5,88,000, 3,36,000. Am I right? Next, plant and machinery, agreed value is there. For Galaxy, agreed value 2,52,000. For Galaxy, which is 2,52,000. Sir, for Glory, nothing was mentioned means we can consider at the book value, which is at 84,000. So which is plant and machinery. For Galaxy, don't consider the book value because they are given the agreed value, which is at 2,52,000. Okay, fine. Next, come to the motor vehicles. Only for Galaxy, no for Glory. Next, come to current assets. There is no other information. That's why current assets one by one, please consider inventory. At book value only 3,36,000, and this is 4,38,000. Next, trade receivables. How much? 4,62,000. Can I take Glory? Can I take Glory, guys? No. For Glory, the trade receivables who collected? Liquidator of Glory Limited is appointed for collection of trade debtors. That's why trade debtors and trade payables are not transferred to the purchasing company. They already told, sir, assets which are taken over. Now the trade receivables is not taken over. Don't consider anything. Apply your mind. Then come to the cash at bank. So come to the cash at bank. So which is 2,38,000 straight away for Galaxy, and for Glory 1,04,000. Is it right? No, we already decided 24,000 is the remaining cash balance after making payment to the creditors, after making payment to the liquidator remuneration. Remaining balance 24,000 is only within the hands of the liquidator. Such 24,000 only. The balance cash will be taken over by the new company. That's why the cash you can consider 24,000 here. I hope all assets considered, including the goodwill, including the cash balance. Now you can reduce the liabilities. Less liabilities taken over. So first one, debentures. Come up. 6% debentures. It only had by Glory. 6% debentures of selling company. Now we already seen that discharged at par only. Discharged at par means taken over at par only. But what are the debenture we are issuing? That debenture is issuing with premium. Sir, taken over at par means the par value is here 3,30,000. At the same value, we are taken over 3,30,000. For Galaxy, nothing. What are all other liabilities? Trade payable. It is same 4,20,000. For the Glory, don't consider anything. Why? Trade payables, who is discharging? Trade payables is also discharged by liquidator. Is it okay? Fine, all of you. Then let me know the NAVs quickly. NAV which is equal to PC. So one by one, first all of you add for Galaxy, guys. 4,48,000, 5,88,000 plus 2,52,000 plus 56,000 plus 3,36,000, 4,62,000. Oh, sorry. 1 second. I added liabilities also. Just a moment. Let me calculate once again quickly. 4,48,000 plus 5,88,000 plus 2,52,000 plus 56,000 plus 3,36,000 plus 4,62,000 plus 2,38,000. So total of assets I got 23,80,000. Reduce the liability. Liability is only 4,20,000, which is trade payable. I got 19,60,000. Am I right? NAV for Galaxy 19,60. Now you can calculate for Glory. So here I got 7,20,000. For Galaxy 19,60, for Glory 7,20,000. What is the first question? Compute the number of shares to be issued to the shareholders of Galaxy Limited and Glory Limited. Therefore, number of shares issued by Glorious Limited. Glorious Limited. 19,60,000 divided by 10 rupees. That equal to 1,96,000 shares. Here 72,000 shares. Am I right, guys? It's absolutely correct, right? Now PC is over, major burden is over. And one more thing, sir, is there any chance of occurring goodwill or capital reserve? If you check here, PC is equal to NAV. No goodwill, no capital reserve. Okay, PC we calculated under NAV method. That too PC is recorded par value only. Now I should need to prepare the balance sheet. All of you come to the balance sheet preparation. Balance sheet of Glorious Limited. Okay. Amalgamation is amalgamation in the nature of purchase. Start with equity and liabilities. Guys, one thing, guys, in the exams, at least you may build 2 to 3 balance sheets here. Always, you can take from any chapter, whether it is either from internal reconstruction, or whether it is from amalgamation, or whether it is from buyback of equity shares. Do you understand? Or it may be from banking companies, or it may be from what else, guys? That is what you can call employee stock option plan after issue something like the ESOP. From most of the times they are not asking the balance sheet, just they're asking the computation issues. So that's why always please be prepared to build at least 2 to 3 balance sheets in the exams, right? That's why from the given information according to the chapter, your mindset should need to tune up. Okay, what are all components will come, sir? Yes, this is a pure amalgamation. Yes, this is amalgamation. That's why purchasing company is altogether a new company. Okay, no problem. So for the purchasing company, there are no existing assets, no existing liabilities. No need to think about the purchasing company assets and liabilities. Only you should need to think about purchasing company, selling company assets and liabilities only. Now, while calculating the share capital or while working the share capital, now PC, how the purchasing company issued, you should need to check. Right now itself, the information is clearly given. So if it is nothing is mentioned, the entire purchase consideration is going to issue in the form of equity shares only. That's why here 19,60,000 equity share capital, here 7,20,000 equity share capital. Total share capital, how much it is? 19,60,000 plus 7,20,000. So total it will become 26,80,000. If you go for share capital, number one share capital, it will be 26,80,000, which is nothing but PC only. Next, you can go for reserves and surplus. Sir, reserves and surplus. In this case, PC is equal to NAV. That's why no goodwill, no capital reserve. Na? That's why no need to consider any capital reserve. But one thing is sure, it is clearly given that debentures are issued with premium, issued at premium. Am I right? Now discharging at par means 3,30,000 I should need to discharge, divided by 110 rupees per each share. That means how many, 110 rupees per each debenture. Then 3,30,000 divided by 110 means how many number of debentures I should need to issue? 3,000 debentures I should need to issue. 3,000 into 100 rupees face value. 3,000 into 10 rupees. 30,000 is the securities premium. Tell me, guys. So now at the time of cancellation of the 6% debentures in the purchasing company, what is the journal entry? 6% debentures of selling company account at R. 3.3 lakh. 2. Our own company debentures. Let us assume those are also 6% debentures. To 6% debentures 3 lakh. To securities premium 30,000. Now that securities premium where I should need to show? Under reserves and surplus only I should need to show. That's why securities premium 30,000. Next, long-term borrowings. Just now you issued the 6% debentures, which are 3 lakhs. Sir, remaining, what are all the liabilities we have, sir? You can check the trade payables. We have the trade payables for 4,20,000. Am I right? Then you can come here. Fourth one, current liabilities, which is trade payable. So trade payable is given at how much, guys? 1 second. 4,20,000. Always see the NAV values. You will have good idea and clarity as well. 4,20,000. You can cross check any other liabilities you taken over apart from debentures as well as trade payables. Nothing were taken over. So with this, total of liabilities is over. Now you can come with assets. Under assets, non-current assets. Under non-current assets, PPE, property, plant and equipment. Sir, PPE also here it is given clearly. Now you can add these totals. You can add these totals clearly. PPE. Just make it total 5,88,000 plus 3,36,000 plus 2,52,000 plus 84,000 plus 56,000. So total PPE I got 13,16,000. Total. Three lakh 36 plus 4,38. So total 7,74 is the inventory. Next, come to trade receivable. Trade receivable only it have by Galaxy, not by Glory. 4,62,000. So you can take that one 4,62,000, and the final one is cash and cash equivalent. You can add the cash and cash equivalent, guys. 2,38,000 plus 24. So which is 2,62,000. Right? Hope I considered all assets. If you can make it total of equity and liabilities, and if you can make it total of all assets, then it will be tally, guys, automatically. You can check from your end. I don't want to make it calculate and tally it. Okay. Hope I considered all things. That's it. What is the big deal here? You know for how many marks they tested that question? They tested that question for, I think so, either 12 marks or for 20 marks. I think so. They might test it for 12 marks. In that question number 2, what is for 2, then no doubt about it, which is for 20 marks only, not for 12 marks as well. So 20 marks question. But what you should need to do, you should need to apply your mind. That should be required. Please explain securities premium calculation again. Oh my dear. Already explained at the time of reading the problem, na? Come to the point number 1, first point. Sir, so many members are confusing at this stage. I told you a simple technique already. Once again, I am repeating. Whenever we are paying something to the equity shareholders of the selling company, or preference shareholders of the selling company, or the debentures of the debenture holders of the selling company, you should need to check one thing here. Discharged either with para or premium. Now, to discharge this, you are issuing certain either equity shares or preference shares or debentures. Na? How you are issuing this component as well? Is it para? Is it premium? Now that part, you know, while reading the sentence given in the problem, you should need to apply your mind here. The debentures of Glory Limited are to be discharged. Comma is also there clearly. If comma is given means that sentence is over. Discharged, nothing is given means always you can presume that discharge happened at par. By the issue of 8% debentures of Glorious Limited at a premium of 10%. By the issue. Now the issue is happened at premium. That means issue is happened at premium. Discharge is at par. Issue is happened at premium means whatever the debenture we are issuing at premium at the rate of 110 per share, 110 per debenture. Discharge with par means, sir, total worth of debentures is almost 3,30,000. Now I should need to discharge by paying the amount of 3,30,000. Now this 3,30,000, how I am issuing per each debenture? Each debenture I am issuing at 110 rupees. Then how many debentures I should need to issue? 3,000 debentures I should need to issue. If you issue the debentures, what is the journal entry? 2 debentures, 2 securities premium. Na? You should need to cancel the debentures of the Glory Limited. That is debentures of Glory Limited account debtor 3,30,000. You are issuing the Glorious Limited debentures. That is 2 debentures account. How many debentures? 3,000. 3,000 into 100, 3 lakhs. 2 securities premium 30,000. The same securities premium only I shown in the reserves and surplus. Okay. Hope you got everything, guys. Now tell me, my dear friends, is it amalgamation chapter is easy or difficult? Provided your concentration is required. Easy, correct? No one is telling here it is easy. We're almost at the end of the chapter. No one is telling. Fine. Let us see one more problem. Let me take one more problem into the discussion. One more exam problem. Which problem can I consider? Yeah. Please come to November 2020 exam problem. All of you. Which is problem number 13. November 2020 exam problem. After practice, easy. Absolutely, guys. Without practice, don't go to the exam. Why? Because even though you have good conceptual knowledge, you have good idea about the subject, you may not present the answer because preparation is different. I mean, while preparing, what you will do, okay, what adjustment will come? If this come like this, I should need to adjust like this. Up to that part only you will think while you are preparing for the exam. But in the examination, what you should need to do, you should need to present the answer. While presentation, lot of issues coming into the picture. You should need to concentrate on calculation. That is one part. That is clerical thing, but still your concentration levels are decreasing due to that calculation issues. Number two, when a particular item should need to present, first from with which I should need to start, where I should need to present, the appropriate items I should need to consider at the appropriate time. For example, in the resource place, if I ignore, I know the concept, guys, but the problem volume is big, If I forgot to include in that part under reserves and surplus, then my problem doesn't tally. Then you may lose your confidence where I committed a mistake. What is the problem? But literally speaking, you are not committed any mistake. You forgot something. That also plays crucial role in the exams. So that's why if you make perfect practice, then you can only able to present that part in the exams. Guys, not only for the chapter amalgamation, here I'm talking for the part of entire financial accounting, whether it is accounting or advanced accounting, whether if you go to the financial reporting, the same thing will continue. But if the problem size is very small, like accounting standards and all other small problems, then you should need to provide your concentration on knowing the answer only. But sir, where I should need to present, should need to recollect everything? No. At that point of time, your application mindset, maybe you should need to apply. Where application mindset will dominates. Here, recollecting the things and presentation at the appropriate time, along with the little bit of application mindset, will be helpful. So all these will place the important role. Here I am a faculty. I'm not only telling the concept, just resolving the problems. So at the end, you should need to able to resolve such problems in the exams, right? Then only you will get the success. So that's why please all of you add such inputs and consider such inputs while preparing for exams itself and make it present the answer in the peaceful manner. And one more thing, guys, in the preparation also, don't make it preparation in your air simply. For example, almost I thought in and around 14 problems in my classroom or 13 problems in my classroom. If you open the study material, it also approximately it contains 15 problems like that. If you consider RTPs, MTPs, previous exams problems, it may almost drag to 20 problems. Then is it possible to a normal human being to cover the entire 20 problems in the preparation stage by writing each and every problem, by writing each and every answer for a problem? That is not possible. I too agree. Then what I should need to do, sir? At least you can consider 2 to 3 big problems after completion of your preparation. Whether you can able to make it present on your own or not, you should need to check. It is possible for 2 to 3 problems. Definitely you can able to spend minimum 1 hour to 1.5 hours for checking your accuracy. The checking of accuracy is mandatory, guys. Okay, fine. Guys, just a moment. One important call. I'll make it answer and I'll come. Just a moment, please. Yeah, right. Guys, do you have any questions with respect to your preparation? I'll give good answers, definitely, because I have a lot of experience in handling the exams. I almost taught for more than 10,000 students till now from different curriculum of CA as well as CMA. I'm seeing the question papers since 2012 onwards, almost 8 plus to 10 years of question papers I seen. I know the examiner's expectations and the students' preparation level, all such stuff. If you have really any doubt with respect to that one, here I'm providing my mail ID as well, which is CA Satyaraju 2016 @gmail.com. You can come back with your questions. Definitely, I'll resolve your doubts within 24 to 48 hours. I'm not regularly watching my mail, but definitely whenever I have time, I'll check my mails. I'll definitely give a reply to the students. And this is not the end of our journey. After completion of our classes also, you can still connect with me at any point of time. You can resolve your queries, not only for these chapters, for any chapters related to the accounting. Okay, fine. Some of our friends asking, sir, how many hours I should need to study, sir? Sir, that is completely depending upon you. I can't tell like that. Sir, you should need to study for 15 hours per day. You should need to study for 18 hours per day. I unable to tell like that. Based upon your caliber, based upon your revision style, based upon your conceptual clarity, based upon your timing, and on your concentration levels, and on your past performance, please estimate yourself. So take one day, how much portion you completed within that day, you can check. Based upon, you can estimate for the remaining portion. Then you can decide your time strategy and your number of hours. And one more thing, guys, I'll definitely tell you one thing. Don't go for long hours. Don't go for long hours. Long hours means 15 hours is a very long hours in my point of view. I never suggested. What maximum hours can I spend in a day, sir, while I am in the preparation, sir? It is maximum will be 8 to 12 hours. Because we are the human beings, guys. When you are reading continuously for 8 hours itself, our brain will be stopped at the end of 4th hour. Definitely. So no doubt about it. This 8 to 12 hours also, how you should need to plan, give a proper breaks and revise the things and make a discussion with your good friends. Don't take with a lot of friends as well. Either one or two friends. Whatever you read till now, you can revise with him. Sir, if no one is available, revise with yourself. Do you understand? Like this, if you do one by one chapter and one by one complete paper, then you will easily gain your confidence level. It doesn't come within a day. It doesn't come within a week. Once you are doing the same activity continuously and rigorously, no doubt about it, guys, how the examination paper will be. Definitely you will be in the qualified list. Okay. And if you give your good efforts, you may surprise yourself. You may end up with rank as well. So I spoke with some of the rankers. So what they told, sir, I never realized the fact that I will get a rank. That's true. What they said was true as well. The reason is, sir, to get a rank, how much preparation I should need to work out, sir? No one will know. So if you make it the preparation style and everything in good manner, if it is going into the deep manner, you will automatically realize that fact after writing the exams. You may feel that, yes, I wrote the exams very well, but you never feel that you will get a rank, but automatically you will surprise at the end of the result, you will get the rank. Okay. That's it. Super. Let's come to the one more problem. Let me take problem number 13. It's too much of time I dedicated for your preparation and all other stuff. I almost spent 5 minutes. I don't want to waste your valuable time. Let me continue with problem number 13. Is it okay? Can I continue? Is there any other queries? Let me check quickly. Then we'll go for problem number 13. Sir, are you on LinkedIn? I'm not in LinkedIn, guys. I'm in YouTube. You can watch. Okay. Guys, I'll give the PDF as well. Some of our friends, they are asking. Don't worry. I have excellent PDF notes, which was written by me. The entire PDF notes I will share with you at the end of my classes, not at this point of time. If I share this PDF, you're always looking about this PDF only. You are not listening my class. With that reason, I'm not sharing this. Okay. Don't worry. I keep it in mind. I'll share it at the end of classes. Okay. Now this is the time for problem number 13. Come down, sir. High limited and low limited were amalgamated on and from 1st April 2020. A new company, Little Limited. New company means which is a purchasing company. Was formed to take over the business of existing companies. The summarized balance sheets of High Limited and Low Limited as on 31st March 2020 are as under. Okay, if you check assets, land and building is given, plant and machinery, investments, under current assets, stock, debtors, bills receivable, cash and bank were given. Under equity and liabilities, equity share capital is there, 14% preference share capital is there. Under reserves and surplus, revaluation reserve, general reserve, investment allowance reserve, and P&L account are given. And come to non-current liabilities, 13% debentures are there, face value 100 rupees, unsecured loans, current liabilities, and provisions. Under that, secured sundry creditors and bills payables were given. If you check, equity shares face value 100 and preference shares face value also 100. That is the given information. Come down. First, let me read the requirement. I'm too excited to know the requirement. First of all, prepare the balance sheet of Little Limited as on 1st April 2020. After the amalgamation has been carried out in the basis in the nature of purchase. This is also one of the exam problem. They clearly mentioned which method of accounting treatment you should need to adopt in purchasing company books. Purchase method. Sir, above problem. What that? This problem. Just now we completed now. What is this? This is problem number 11. This is Jan 2021 problem, where method of amalgamation they're not mentioned, but still we adopted the purchase method. That is the reason why I'm telling in some of the problems they are directly providing the method of amalgamation. In some problems they are not mentioning, they are telling that you should need to identify from your own, from the available information. In some of the problems what they are telling, they are providing the ambiguity. Ambiguity means it is applicable in case of amalgamation in the nature of purchase as well as amalgamation in the nature of merger as well. Then what you should need to apply, then provide a clear-cut assumption. Based on that assumption, you can give the answer. That is in very remote situations, in very remote areas. Okay, fine. Come down. Now, other information. 13% debenture holders of High Limited and Low Limited are discharged by Little Limited by issuing such number of its 15% debentures of 100 each so as to maintain the same amount of interest. Just a second here. Muhammad is repeatedly messaging me. Muhammad, what is your issue? Let me know. Sir, please tell how many chapters each day. Oh my God. After telling this much of story again, you are asking, sir, how many chapters? You can't take it granted, yeah. How many chapters? Do you feel that each and every chapter size is same? No, that's not correct. Then how you can take, sir, if I tell 3 chapters per day, then is it, do you think that amalgamation, internal reconstruction, liquidation of companies, is it possible within a day? No, don't make it, prepare your strategy like that. So based upon the content and the chapter size, you can allocate the number of hours. Okay, fine. Okay, let me continue. 13% debenture holders of High Limited and Low Limited are discharged by Little Limited by issuing such a number of its 15% debentures of rupees 100 each so as to maintain the same amount of interest. Sir, what is the meaning of same amount of interest? What the debenture holders of the selling company feels, sir, in the selling company, how much interest we are getting, in the purchasing company also, we should need to get the same amount of interest. Whatever the percentage of debentures you are issuing, that is irrelevant for me. But whatever the amount of interest we got in the selling companies, the same amount of interest we should need to receive in purchasing company as well. Then purchasing company should need to issue that much of quantum of number of debentures to the selling company. That is the matter of discussion. Sir, simply in selling company, how much amount of interest you are getting? Let us check. 2 selling companies are there. Number 1 is high and low. If it is check here, 100 into 13%, they are getting 13 lakhs rupees in lakhs here. 100 into 13% means 13 lakhs they are getting in high. 100 into 13%. Now, how many number of debentures or how much worth of face value of debentures purchasing company should need to issue? I don't know. That is face value of the debenture should need to issue. But on such debentures, debentures holders will get how much interest? 15%. Then if you want to know the face value of the debentures need to issue, X is equal to 13 by 15%. This is for high. Similarly for low, 56 into 13% is equal to X into 15%. Therefore, X is equal to 56 into 13% divided by 15%. Now all of you please make it calculate in high limited point of view, in low limited point of view. For high, which is 86.66 lakhs here. Here it is 86.66 lakhs face value of the debentures they should need to issue. But if you want me to put it into accurate figure, 86.67 lakhs. Then for low, 56 into 13% divided by 15%. Here it is 48.53 lakhs. Okay, what is this actually? Amount of face value of the debenture should need to be issued to the debenture holders of the selling company. Next, preference shareholders of the two companies are issued equivalent number of 15% preference shares of Little Limited at a price of 125 rupees per share. Equivalent number means for 14% preference shares of High Limited, 320 lakhs divided by 100 means 3.2 lakh shares are there. Do you agree? 320 divided by 100 rupees means 3.2 lakh preference shares are there. For each preference share, we are paying 125 rupees each. That is 3.2 lakh into 125 for high. For low, 1.75 into 125. Then you will get amount of preference share should need to be issued. Okay, fine. Little Limited will issue 4 equity shares for each equity share of High Limited and 3 equity shares for each equity share of Low Limited. Simply for every 4, 1 in high, for every 3, sorry, in reverse now. For every 1, 4 shares, for every 1, 3 shares. Little Limited is going to issue 4 shares for every 1 equity share, 3 preference shares for every 1 preference shares in the Little Limited. Am I right? Just a second. Come here, come down. Now for high, we have 10 lakh equity shares. For 10 lakh equity shares, I'm going to issue 40 lakhs. Then in low, for 885, that is sorry, 8.5. I'm so sorry. 850 divided by 100 means, which is 8.5 lakh equity share. For 8.5 lakh equity share, for equity shares in Low Limited, how many number of equity shares I should need to issue? 8.5 into 3, that equal to 25.5 lakh shares. Now for this, what I should need to do? These shares are to be issued at 35 rupees each, multiplied with 35, multiplied with 35. Then I know worth of equity share should need to be issued to High Limited and Low Limited. Now let me know all of you guys with this information. Method of PC, net payments method, no doubt about it. If you make it add this component and this component, then you will get PC payable to High Limited. If you add this component and this component, then you know PC payable to Low Limited. If you add the total, you will know the total PC. Okay, fine. Next, come down. Investment allowance reserve is to be maintained for 2 more years. Sir, it was already given that the method is purchase method. To maintain the investment allowance reserve, you should need to pass one entry, that is amalgamation adjustment account at R2, investment allowance reserve account. So investment allowance reserve is how much given here? 80 plus 40, which is 120 lakhs. Rupees in lakhs only. Simply you can put 120, 120. Am I right? Okay. Now I should only need to prepare the balance sheet. Let me explain this problem with my PDF. I don't want to waste much time on the calculation part. I know the problem number. What is the problem number, guys? 13, right? So you can go to the last problem. Here it is there. Come down, guys, all of you. Problem number 13. Calculation of PC under net payments method for High Limited, for Low Limited. So to equity shares. For each equity share, 4 equity shares. That is 10 lakh into 4 into 35. We already work out here. That is 40 lakhs into 35. So they got 1400 lakhs here. Here 8.5 lakh into 3 into 35, that is 892.5 lakhs. That is to equity shareholders. Similarly, for preference shareholders, we already work out here 3.2 lakh into 125, which is 400 lakhs. It is 1.75 lakh into 125, 218.75. Now the purchase consideration to high limited was 1800 lakhs, and for low limited was okay 1111.25 lakhs. Is it okay, guys? Next, to build the balance sheet, I should need to know one more thing. While comparing PC with NAV, whether you are getting goodwill or capital reserve, you should need to work out. For that purpose, I will calculate the NAV. So this is NAV of the business taken over. All the assets we are taken over, right? All assets, nothing was mentioned. Sir, all assets at which value were taken over? Nothing was given. Sir, nothing was given means we are taken over at book values only. That's why assets taken over at the rate of agreed value for the given information just I considered 23151588. Liabilities taken over at the rate of agreed value. One of the liability is 13% debentures. Sir, for 13% debentures agreed value we already considered in the problem itself. 86.67, 48.53. The same thing was considered here. Next, other liabilities. What are all other liabilities? 50, 65, 30. If you make it total here, 50 plus 65 plus 30. Other liabilities other than debentures was 145 here. This is only 35 here. I considered. Then NAV I got. Now you can compare PC with NAV. PC is 1800. NAV is with 2083.33. Now PC is less than NAV. That's why which is a capital reserve situation. Next, come here. PC is 1111.25 and the NAV is 1504.47. Now again the situation is PC less than NAV, which is capital reserve. Sir, for example, for one selling company, if you derive capital reserve, for the other selling company, if you derive goodwill, what I should need to do, sir? You can nullify with each other, then the net goodwill or net capital reserve you can represent. Do you understand? If while acquiring one selling company, if you are end up with capital reserve, if you are acquiring another selling company, it may end up with a goodwill, then you can nullify with each other, then the net goodwill or net capital reserve only you can need to show in the balance sheet. Now come to the balance sheet. So one more additional entry also you should need to maintain in the balance sheet, which is amalgamation adjustment to investment allowance reserve. Now share capital, sir, here itself is there, sir, share capital. Clearly you can check, but don't multiply with 35, multiply with 10 rupees face value. Over the face value 25 rupees you should need to show in the securities premium. Similarly, coming to preference share capital, only multiply with 100. Over the face value 25 rupees per share you should need to show in the securities premium. Here also in my PDF, I'm not maintaining the balance sheet, just I provided the synopsis. So share capital maintained with face values only. Here also multiplied with face values only. Okay. Next, reserves and surplus. Securities premium. Here 25 rupees per share. Here also 25 rupees per share. So the same securities premium, if you check for equity, this is, for preference, this is total under securities premium. While comparing PC with NAV, you got the capital reserve. So the capital reserve also I made it. Investment allowance reserve, just I need to maintain amalgamation adjustment account negative. Next, debentures. Sir, debentures, you know already the values. If you make it total, you can make it present under the long-term borrowings. What about the remaining liabilities and assets, sir? Simple line by line addition. Why? There is no change. All assets simple line by line addition. Remaining liabilities like sundry creditors, bills payable, line by line addition. With this problem is over. So these are the things only you should need to concentrate. If you know, balance sheet preparation is dead easy. That's it, guys. This is things related to problem number 13. Guys, I will give one more problem as HW. Please all of you complete your end. What is that problem is? Just a second. Actually, I intended to tell that problem in the classroom, but we are having very less time. Okay, let me consider this problem anyway. We are having only 10 minutes time, right? I am unable to start with the new problem. Just let me take up this problem. At least I can give the broader idea. Okay. So please all of you, let us take up problem number 8 quickly. Please all of you come to problem number 8. One of my friend, sir, please explain adjustments of problem number 6, which was given as HW. Really, I unable to find the time in this lecture. I'll try to explain that if at all, if I get the time in other lectures. Okay, please consider it. Otherwise, we will miss out one good problem. Okay, the financial position of two companies, Hari Limited and Vayu Limited, as on 31st March 2015 was as under. First, let me directly go with the requirement. Prepare necessary ledger accounts to close the books of Vayu Limited. That is selling company books I need to close. And show the acquisition entries in the books of Hari Limited. Purchasing company books I should need to pass the journal entries. Also draft the balance sheet after absorption as at 31st March 2015. Okay. So total entire conceptual things were covered in this problem. Now given information. Under shareholders funds, share capital given, reserves and surplus given. Under share capital, if you check, equity share capital is there, 9% preference share capital is there, 10% preference share capital is there. I mean for Hari, equity and 9% preference share capital. For Vayu, equity and 10% preference share capital. So equity shares 10 rupees face value, preference shares 100 rupees face value. Under reserves and surplus, only one reserve is there, general reserve is there. Then trade payables given, short-term provisions were given. One more note is there, now tangible assets. Under tangible assets, if you check, split was given building and machinery. Remaining all are the general assets, guys. Inventory, trade receivables, cash and cash equivalents. And intangible asset goodwill is also there. Come down. Hari Limited absorbs Vayu Limited on the following terms, which is the pure absorption. Absorption means an existing company will take over another existing company. Hari Limited absorbs the Vayu Limited. Hari Limited is a purchasing company. Vayu Limited is a selling company. 10% preference shareholders are to be paid at a 10% premium by issue of 9% preference shares of Hari Limited. Paid at 10% premium. Paid at a 10% premium means discharged with premium, but issue is at par. Discharged with premium means, come to the preference share capital. For this 1 lakh, we are paying 1,10,000. For this 1 lakh also we are paying 1,10,000. But the issue is at a par only. That means how many number of preference shares we are going to issue? 1100. Am I right? 1,10,000 divided by 100 means, which is equal to 1100 preference shares. Super. Next. Goodwill of Vayu Limited is valued at 50,000. Buildings are valued at 1,50,000. And the machinery is at 1,60,000. These are agreed values. What about the remaining other assets and liabilities of Hari Limited and Vayu Limited, sir? If nothing was prescribed means such assets and liabilities are taken over at book values only. Okay, super. Inventory to be taken over at 10% less value and provision for doubtful debts to be created at the rate of 7.5%. Equity shareholders of Vayu Limited will be issued equity shares at the rate of 5% premium. Okay. Equity shareholders of Vayu Limited will be issued. Purchasing company is going to issue equity shares at the rate of 5% per premium. Issue price is at the rate of 105. Prepare necessary ledger accounts and close so and so and prepare the balance sheet. Now my first question, method of PC. Method of PC. All of you, please participate and let me know quickly, guys. I'm having very less time, only 5 minutes time. Please, all of you, let me know method of PC. If you're unable to find out the method of PC, then you will stop at that position. You will apply the different method, then problem gone. Just let me know, all of you. PUs, NAV, super, yeah. Extraordinary answer. So the method of PC is net asset value method. All of you, please apply the same concept. I'm not telling again new concept. From the given information, you can able to ascertain how much amount payable to equity shareholders, how much amount payable to preference shareholders. If you know, then method of PC is net payments method. Otherwise, method of PC is net asset value method. Sir, it is given that purchasing company is going to issue equity shares at the rate of 105. But how much value for which I should need to issue, they are not providing. Simply discharging at which price they are not providing. How much worth I should need to issue? I don't know, sir. Then just they are tempting in point number 4 that you should need to apply the net payments method. But that's not wrong. There is incomplete information. How much amount I should need to payable to the equity shareholders of the selling companies? I don't know, sir. But at which price I should need to issue, I know 105. That doesn't relevant for me. Actually, to know the total amount of PC. Actually, what is relevant? How much amount I should need to issue to the, how much amount I should need to payable to the equity shareholders of the selling company. That information is missing. Then net payments doesn't work out. Then I should need to apply net asset value method. Now, let me explain the same thing with my PDF once again. Due to lack of time, I'm using my PDF content. Come down. Sorry, come up. Yeah, this problem. Hurry limited problem, right? Now, calculation of PC under NAV method. So now we are, that is, as which company is purchasing company, which company is selling company? Hurry Limited is a purchasing company, Vayu Limited is a selling company, right? Now, for Vayu Limited, we should need to consider all assets and all liabilities. Some of the assets are at agreed value, some of the liabilities are at book value, and some of the assets are also at book value. According to the given information, let us consider first building. So something there is mentioned 1,50,000 agreed value consider. Machinery also considered 1,60,000 agreed value consider. Goodwill also they given, which is at agreed value, which is at 50,000 consider. Next, if you come down, they're also telling that, just a moment. It was suddenly hanged here. It was given that inventory to be taken over at 10% less value. Inventory is taken over at 10% less value means if you check the inventory valuation, inventory is given at how much price? 1,75,000. 1,75,000 into 90% is 1,75,000 into 90% is 1,57,500. Trade receivables also they are telling that you should need to create a provision for 7.5%. That means trade receivables directly you can consider at the rate of 92.5%. Or else if you want to consider at 100%, reduce the provision at the rate of 7.5%. Both the treatments are over. Directly I considered at 92.5% for the trade receivables. Okay. Next. Remaining all assets at book value. Remaining all assets means cash only is there. So cash is at book value you can consider, which is at 20,000. Then you can come to the liabilities portion. Under liabilities, trade payables is there for 80,000. Then short-term provision is there for 20,000. Then NAV of the business takeover, you got 5,30,000. Out of which preference shares is 1,10,000, right? Just a moment. Where the preference shares? I work out here. So for two companies I work out actually. Hurry Limited is a purchasing company. No need to work out this. Only for Vayu Limited. So which is 1,10,000. So if out of 5,30,000, 1,10,000 is preference shares. Remaining balancing figure is equity shares, which is 4,20,000. Now how many number of equity shares issued by the Hurry Limited? 4,20,000 divided by 105. We already decided issue price is 105. So that's why number of equity shares should need to be issued is 4,000 equity shares, which is 4,20,000 divided by 105. Now, number of preference shares issued as 1,100. Number of equity shares issued as 4,000. This 1,100 into 100 go to preference share capital. 4,000 into 100 go to equity share capital. For securities premium, 4,000 into 5, 20,000 will go to the reserves and surplus. In the books of purchasing company, I am telling. And one more thing, PC is under NAV method, no capital reserve, no goodwill. No need to think about that. That means in the books of purchasing company, accounting treatment is the DC, business purchase to liquidator of selling company at the rate of 5,30,000, incorporate all these assets as well as all these liabilities, cancel the business purchase. Let's make payment to the liquidator of selling company for 5,30,000 to preference share capital. That is 1,10,000 to equity share capital, 4 lakhs to securities premium, 20,000. Entries in the books of purchasing company over. Sir, then what about accounting treatment in the books of selling company? 5-step approach. All assets taken over. Simply you can make it transfer to the realization. All liabilities taken over. Simply you can make it transfer to the realization. Equity shareholders funds like equity share capital, reserves and surplus, transfer to the equity shareholders account. Then PC due, purchasing company to realization, Hurry Limited to realization. Then what are the PC you are getting? Then the PC you are getting is 10% preference shares of Hurry Limited. sorry, preference shares of Hari Limited, equity shares of Hari Limited to Hari Limited, then Hari Limited account closed. Then whatever the PC you are getting, just you can make distribute among the existing preference shareholders and equity shareholders and all other liability holders in the particular order. There is no liability holder. That's why you can make it first make it payment to the preference shareholders. Sir, preference share capital 1 lakh, but you are paying 1,10,000. You are getting certain profit or loss. That profit or loss, again, you should need to make it transfer to the realization account. Then finally, you should need to make payment to the equity shareholders account. To pay the equity shareholders account, what you have? I have equity shares of the purchasing company to the extent of 4,20,000. After transferring realization profit or loss to the equity shareholders account, equity shareholders is also representing with 4,20,000 only. Such 4,20,000 just you can pay. Then equity shareholders account close. Then equity shares of Hari Limited account also closed. With that, books of accounts of selling company got closed. Then preparation of balance sheet is up to you. Take the Hari Limited assets, add the agreed value of the Vayu Limited assets. No capital reserve, no goodwill. Related to share capital, existing share capital of Hari Limited plus PC issued. Securities premium, I already told you 20,000 you should need to put along with the reserves and surplus of the Hari Limited. Remaining all are line by line addition of assets and liabilities with the agreed value. If nothing is specified, with the book value. That's it. Okay. So this is one more important problem. Why I am picking this problem? In this problem, if you go blindly for computation of PC, you may go into the wrong direction. Here, PC computation by applying the NAV method is only the crucial part. I think so. Various types of problems, amalgamation in the nature of purchase, amalgamation in the nature of merger, different methods of PC, identification, different adjustment while discharging for debentures, and the liquidation expenses adjustments, and intercompany owings adjustment, stock reserve adjustments, various issues were considered through various problems, guys. But every adjustment was covered through every problem. So it's my sincere request to all of you, please take some of the RTP problems or the MTP problems or the exam problems and make it practice. Still, if you have any doubt, please let me know. From the next class onwards, we are going to start with the next chapter, which is internal reconstruction. I'm purely dedicating approximately for 2 lectures for internal reconstruction, and for the other 2 lectures, let us dedicate for liquidation of companies. Somewhat liquidation of companies is a bigger chapter while compared with internal reconstruction, but still the weightage is a little bit low. That's why 2 hours, that is 2 sessions is more than enough. Until bye guys, have a nice day, signing off.